mental accounting, why money isn't fungible in our minds. Today we're diving into one of the most fascinating concepts in behavioral finance that affects how each of us makes financial decisions every single day. Mental accounting is the cognitive process where people categorize, evaluate, and track money differently based on its source, intended use, or context. In simpler terms, we create mental buckets for our money. Even though money is supposed to be fungible, meaning every dollar should be worth the same as any other dollar, our minds don't actually treat it that way. Here's how these mental buckets work in practice. Most of us unconsciously divide our money into different categories. Money from our salary tends to go into a bucket labeled for necessities and bills. We're careful and responsible with it. Money from a bonus gets placed in a different bucket, one we label for treats and splurges. And money from winnings, like a lottery or casino, goes into yet another bucket that we associate with taking risks and having fun. Same money, different mental labels. Let's look at a classic example that demonstrates this bias. Imagine you have $100 from your salary versus $100 you won in a lottery. It's the exact same amount with the exact same purchasing power. But research shows that most people treat lottery money as quote-unquote free money and spend it much more freely than earned income. This is mental accounting in action, and it's completely irrational from an economic standpoint. So why does our brain engage in mental accounting? There are actually several good reasons. First, it simplifies complex financial decisions by breaking them into manageable categories. Second, it helps us track spending by creating natural divisions. Third, it creates a sense of psychological ownership over different pools of money. And fourth, it reduces anxiety about money management by giving us a feeling of control. Mental accounting is essentially a mental shortcut that makes our financial lives feel more organized. Mental accounting leads to several common biases. The sunk cost fallacy occurs when we attend a concert despite being sick, simply because we already paid for the ticket. Payment decoupling happens when we spend more freely with credit cards than with cash because the pain of payment feels distant. The house money effect causes us to take bigger risks with investment gains than with our original principal. And goal-based spending can make us refuse to use our emergency fund even for genuine emergencies, because we've mentally locked it away for a specific purpose. The real-world impact of mental accounting is significant. Consider how differently people treat a tax refund versus their regular salary. Tax refunds are often treated as bonus money and spent on luxuries or vacations, while regular salary is used carefully for bills, savings, and essential expenses. But here's the reality. A tax refund is just your own money that you overpaid to the government throughout the year. It should be treated exactly the same as any other income. Mental accounting has a dark side that can lead to poor financial outcomes. It causes suboptimal decisions, like carrying expensive credit card debt while simultaneously maintaining a savings account earning minimal interest. It increases risk-taking behavior, such as gambling more aggressively with house money or winnings. And it promotes wasteful spending, like splurging on bonuses instead of treating all income equally and making rational allocation decisions. Fortunately, there are strategies to overcome mental accounting. First, consciously remind yourself to view money as fungible. Remember that all money has equal value regardless of its source. Second, focus on your total wealth rather than individual accounts. Look at your complete financial picture when making decisions. Third, make rational comparisons by evaluating opportunity costs across all financial decisions. And fourth, automate your financial decisions by setting up automatic savings and payments to reduce the influence of cognitive biases. Here's the key takeaway. Mental accounting is a natural cognitive shortcut that all humans use. It's not necessarily bad, but being aware of it helps you make more rational financial decisions. At the end of the day, money is money, regardless of where it comes from or what mental label you give it. The next time you receive a bonus, a gift, or a windfall, pause and think holistically about your finances. This awareness alone can help you make better choices with your money.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.